Hey everyone, welcome to another episode of Mayhem in the Markets, coming to you Friday, May 26th, 2023, and brought to you by Macrovisor, where we make macro easier and actionable. Dollar-denominated debt to emerging markets is diminishing. We've seen this led by Latin America, where issuance fell to $64 billion in 2022. That was down 57% from 2021. And that was the lowest issuance since 2008. Asian emerging market debt took a similar path lower. And what this is showing us is that there is less appetite for debt at these higher rates, and certainly less appetite for dollar-denominated debt when we've seen rates in dollar-denominated debt be among the faster rising. Certainly euro-denominated debt is a little more attractive in this environment, but debt as a whole has become less attractive because of these rates, making it much harder to maintain. So it's something to keep in mind because this is the largest change, the largest decline since the Great Financial Crisis, and the second largest on record. Next up, we have the rise of the debt ceiling, which to me looks a little more like an elevator than a ceiling. I don't know about you, but this doesn't really look like a, let's say, restrictive measure that's been effective in reducing debt. I think we can safely say that this is much more theater than substance, that it doesn't really help our country get around the problems that we see here. And if you're not in America, you've got to be looking at us and laughing, or at least wringing your hands in frustration with how much you hear about this stuff. Does it matter? Sure, it matters, but not in the way you might think. We won't be defaulting, but all the news about the debt ceiling and the just inability to come to a consensus and all these last minute negotiations on key areas, this is not a sign of a government that is doing their job very well. And I think that's a concern because we see that diminish the confidence of foreign investors in our sovereign debt when they see that they really can't get their act together in Washington, D.C. to figure out where the budgetary priorities are, where things can be cut, what amount of money should be spent. And these are the bare rudiments of being a legislator. It should be something that's a priority to figure out a prudent path forward for fiscal restraint where possible, but also for balancing a budget. And increasingly, we're paying so much on our debt. We're set to pay over $1 trillion a year on our debt pretty darn soon with rising rates. That'll be bigger than the Pentagon's budget, which is about $886 billion a year and rising every year. But currently, we have a debt ceiling of $31.4 trillion. We're very close to hitting that. Yellen has said by June 5th, we will be essentially hitting that debt ceiling, which would necessitate likely a government shutdown if there is no other options available at that point. I believe we'll likely resolve this in a timely manner, because they are starting to make some progress, talking about potentially cutting some of the excess funding for the IRS that was passed. I think it was 80 billion or so, and their GOP are doing what they can to try to cut that. And the defense spending is probably not on the table, even though the Pentagon can't account for about a third of where that money goes. But I think it's important to take into consideration that we're still going to have an increasing budget, even though they're putting a spending freeze in place for 2 years, that the budget that was passed is an increase, and that there's a lot of spend from the Inflation Reduction Act and the CHIPS and Science Act built into that, that's going to continue for some time to come. We can see that credit default swaps remain elevated. They are starting to recede a bit. The one-year swaps setting the highest levels on record, and the 5-year swaps the highest we've seen since the 2011 shutdown and government crisis. So why does this matter? Because some parties that are buying insurance against a default are a little more concerned that that possibility is real, particularly in the near term with those 1-year credit default swaps that are insuring against a default on 1-year U.S. debt. So why is this important to us? Well, because we're not seeing this stress in other parts of the market, really not in any pronounced way, certainly not in equities. And while rates have been rising in the bond market, it's not commensurate with any level of panic, with the exception of one area that we saw briefly on Thursday of this week, where the T-bills that were expiring between June 1st and June 5th hit levels that we haven't seen on an average basis since 1990. That yield was 7.47%. The yields in 1990, 7.89%. So that's a very, very significant amount of change in the yields on that paper. And that was showing that people holding that paper were more concerned. And so certainly there was an exodus. The credit default swaps are hedging against a default of debt within that same range and maybe a week or two later, in the sense that that would be the debt that would be most likely impacted. Tax payments do come back to the Treasury, starting really leading up to June 15th. And that's because you have your second quarter estimated payments to the IRS. So if you're a business or a contractor, or you earn some other kinds of income, perhaps from dividend streams or otherwise, you're generally going to be filing estimated tax forms. And this is different than people who are employed, where it's withheld from your paycheck. And so the Treasury has a variety of different schedules where they receive taxes. And one of them is these quarterly payments, and business taxes that come in during these quarterly payments tend to be pretty significant. So that is something that could help the Treasury if they aren't at a point where the debt ceiling has been raised at that by that date. And instead, we've seen something like a government shutdown or other measures to defer payments on all other things other than the debt. So we'll have to see how things are moving along, but it is important to keep track of those dates leading up to June 15th, because it is likely we'll have an influx of tax payments by then. But my reading on this has always been, having been through many debt ceiling debacles and kabuki theater in the past, is that it's very unlikely that the government will default. And I know there's folks out there that are saying it could happen or it's more likely. I see it as very low probability, because this is something where both parties ultimately serve corporate interests, and those interests are not to have a default. So I think even though there's a lot of division and there's a lot of drama, there's very low likelihood that there'll be any kind of default event in this country. And I don't think it's going to happen anytime in the near future either. And the U.S. government doesn't really have the ability to do a default without really, really horrific ramifications, not only for the government, but for companies in this country, for households, and for companies and governments and households around the world where there's so much U.S. denominated debt. So if there were to be a default, it would have pretty significant consequences. And I don't think that a lot of the people who are able to have greater influence in DC than just everyday citizens are looking for that type of outcome. I believe that everyone's interests are not having a default, and they see this last minute negotiation technique as something to extract as much value as they can, as much political ammunition for the next election as they can. Small business optimism is not so great. These are levels we haven't seen since 2013, and they are continuing to decline. And there's a lot of reasons for this. One of the reasons is that small businesses have to use revolving lines of credit. And, there's few exceptions for that, where a small business is able to get a fixed rate loan, maybe if there's some kind of collateral involved. But a lot of small businesses have revolving credit. The cost of that credit's continue to go up. The cost of wages has continued to rise. And yet business conditions are deteriorating for a lot of small businesses. So they're seeing their costs go up, they're seeing their revenues and earnings go down, and that's leading to lower optimism, which is putting more jobs in jeopardy as they start to look at cutting operational expenses in situations where they have too much slack, or maybe they have too many people working for them, or too much square footage, too many offices, or otherwise. This is going to become a situation, particularly as the economy slows more, that could cause some weakness, as small businesses are the largest generator of jobs in the United States by a lot. And we can see that they're starting to struggle because credit card payments year over year are falling. And this is not a good sign because small businesses have already had a rough go during COVID. Many were just starting to really recover over the last couple of years, and now they're starting to see some more challenging times, particularly from the summer of last year on. Now, why is this important? Because if small businesses are the largest creator of jobs, the amount of people that could lose work if they start to struggle is pretty significant. We already know a fair amount of small businesses are starting to struggle with their bills, and there's no bailout from banks. That is to say, credit conditions are so tight now that you'll be lucky to even get a revolving line of credit for your small business. You may have to be just forced to use an extremely high interest rate credit card or try to borrow from friends or family. But this is a situation where a lot more businesses can struggle, particularly if we start to see more difficult economic conditions. And we have small business payment volumes to hiring firms falling as well. JOLTS job openings moving in the same direction at the same time. As we can see, there's a pretty strong positive correlation here, further underscoring just how important small businesses are to the labor market. Why is this important for us to pay attention to? Because when small businesses stop hiring, they start firing in aggregate, and that is what you see leading up to a recession. The last shoe to drop is typically the labor market, and we've yet to really see that happen in a meaningful way. And obviously, housing has stayed somewhat resilient as well, but I have a feeling that these two areas will see stress around the same time. And unfortunately, with small businesses starting to scale out of hiring, I do believe that the next leg there is going to be firing, that they're going to be looking at how can they reduce operational costs to survive a more challenging economic environment where unfortunately a fair amount may not be able to persevere, where there is likely to be that combination of rising wages, higher interest rate costs, and the pressure that they're seeing on their business revenue cause more small businesses to have to scale down. And there was so much availability of cheap credit for so long that a lot of businesses are going to have trouble dealing with an environment where if they are able to raise capital, it's going to be at much higher costs. We also see that the net percentage of banks tightening commercial and industrial loans to small firms is significant. This is about 50% between both large and other banks. So that tells us that really from where we started this year to where we are now, credit conditions are vastly different and much tighter. And this is something that is going to put pressure on small businesses because, again, a lot of them have to use credit to manage inventory, be able to buy, the inventory and the goods that sit on their shelves before they're able to sell them off to customers, to be able to pay rent and employees because they might have cash tied up in other assets. And this ends up becoming a big issue because if credit's not available, that's much worse than high interest rates. That means there's no capital available to your small business. I mean, like I said, they might be able to borrow from credit cards for certain expenses, but it's not going to be enough. It wouldn't last very long. And so I'm afraid that this pressure is going to be something that we start to realize. And unfortunately, it's also going to have an impact, particularly on small to mid-sized banks and some of the larger regional banks as well, because they do have a lot of commercial and industrial loans, both to small businesses and to office buildings. Both of those categories are likely to be challenged. So it could put some pressure on banks as well. And net job creation over the last 25 years, you can see in light blue, it is all about the small businesses. Yes, large businesses have been a big contributor as well, but we can see small businesses are more significant, particularly in this post-COVID era. So it's very important that our small businesses do not decay, that they aren't left to languish, that there is some kind of help given as we get into a recessionary environment, because I would be very concerned about where this goes if we see a more significant hollowing out of small business job creation, given how important it is to this economy, how important it is to the aggregate wealth of Americans and the overall prosperity of our country. Small businesses are what can eventually become medium and even large size and S&P 500 size businesses. They all start somewhere. And if it's becoming more difficult to found a business, to have a business succeed, to be able to scale that business, then that also impacts our overall economy in a negative way. So it's really important that we do continue to have an economy that can support robust formation of small businesses, and in some ways, the Small Business Administration helping with the formation of those early stage businesses and those mid-stage businesses so that they can grow and become larger employers and bring about greater prosperity. That's really one of the most important roles that small businesses play in this economy, is hiring so many people, providing them with a lifeline of income and benefits, and allowing them the upward opportunities of growing with that small business. We see TLT versus QQQ, and the jaws are wide open. And this is a really interesting chart because this is one of the largest divergences I've seen. And I think it speaks to just how far disconnected long duration risk, tech growth, all that stuff is from rates. This is rather extraordinary, and I think it does matter. And my own opinion of it is that it will come back, that the rally that we're seeing in tech is likely to catch down to TLT. I think that TLT may remain under pressure because the debt ceiling resolution means that we have about $1.2 trillion of new issuance coming online. And I think that's going to matter a great deal to rates. So my sense is that this is a chart that resolves with the NASDAQ lower. Of course, I could be completely wrong about that. We might be going into a different reality, maybe one where bonds are bid and they catch up. But I see that as a very low probability outcome. Even meeting in the middle seems somewhat low probability unless there's some kind of flight to safety event that triggers money into bonds and out of stocks. For what I can see, there's a very small amount of upward leadership. You can see how the Dow is not doing particularly well year to date. It's basically flat. The Russell's not doing particularly well. The S&P is up, but it's basically at the top of its trading range. And it's really only the NASDAQ in the US that's breaking out. We have China that's down year to date, the Nikkei that's at 33-year highs. So very interesting divergences in cross geography indices as well. But over here in America, the NASDAQ is the wildly outperforming index, and underneath the surface of the S&P, there's only 29% of stocks in the index that year to date are outperforming the broader index. So that is a concern. That's the lowest level since 1999, and that narrow breadth is focused a lot in these mega caps. So that's one reason the NASDAQ is leading. Another is NVIDIA's impressive earnings and even more impressive guidance, which has certainly given us a boost. And then, of course, the idea that the debt ceiling resolution may be coming, although in fairness, the market didn't really price much risk in for the debt resolution, so I'm not sure how much upside will come with that. And finally, on Friday, we've had a lot of folks chasing calls in mega cap stocks, and today was a day where that worked really, really well. So the question is, what does it look like next week? And really, most importantly to me, with the S&P being the key index, does it break above 4,200 on the cash index on a more meaningful basis? Today we were at 42.05 in the close. I'd like to see it above 42.10, 42.15 with continuing upward momentum in the early days of next week to say that we've got some legs in this rally. If we do, I shared 35 trading ideas on TraderAid.com that you can check out, where there's ideas for both above 4,200 and below 4,200 as longs and shorts. And you can get 25% off TraderAid by using the coupon code MEMORIAL25 until Tuesday. And here's that chart of the number of S&P stocks outperforming the index. You can see it's only 29%. That's the lowest level since 1999. That is a really, really narrow amount of breadth. And I think it's a concern in the sense that this is not something you particularly see in a healthy market. I know that breadth doesn't matter until it does, but when it does, it tends to matter a whole lot. And this is worse than the breadth that we saw any time before, really 24 years ago. So Have to go back quite a ways to see this. It's also a market where about 15 stocks of the S&P are leading the markets. 97% of the gains year to date are coming from those stocks. So that's also kind of telling you that there's just very, very narrow concentrated leadership. And there's a few themes, AI being one of them, that's helping to lead the market higher. But when you have so much focus in such a small area, there's risk inherent to what happens with any one of those big stocks that's leading the market higher, potentially undermining that move. But B, also, that narrow leadership is something you don't typically see as part of a healthy market. It's usually not sustainable. And certainly where valuations are right now, that's going to add to that same concern that if it was a new bull market, we're starting from some of the highest valuations that a new bull market ever has, if not the highest. Commercial banks are replacing deposits with borrowings from places like the Federal Reserve. Now, some folks are saying, well, this is like QE because, the Fed's balance sheet is expanding. Well, you have to look at the other side of what that means. The banks are borrowing because they have to. They're having liquidity pulled out, not only because of fear and maybe access to money markets and treasuries at better yields, but also because people do need to pay their bills. So there's been a combination of several different factors going on here, and banks replacing their holdings with borrowings is not something that adds net liquidity to bank reserves. As we can see in this chart, if anything, it's just helping them balance out. So that gives us a little bit of a different picture of the Fed's term bank funding program being anything more than really a facility that helps to neutralize the lack of liquidity, right? It's helping to ensure that banks don't become completely insolvent. With more than 50% of banks having more liabilities than assets, this chart tells us a little bit more about that picture and how there are a lot of banks that are having to borrow to stay afloat. And that's not a sign of a healthy banking system. And remember, at MacroVisor on February 2nd, we identified that there were problems in the US banking system, that there were large amounts of unrealized losses, that there was a significant amount of initial borrowing at the Fed's discount window, and that capital buffers were the lowest level they had been since 2006. We said there were concerns with the banking system before anyone else reported on it, for one. And secondly, we were specific about what those concerns were, that there was a lack of available capital, and that was going to be a potential liquidity and then solvency issue. So one of the things we do at MacroVisor is we focus on trends, we identify themes, and we also look for areas of the market to be concerned about. And this was one that we identified over a month and a half before something happened to the regional banks. So I just wanted to give that a little bit of recognition, because I think it's important that the trends that we identify, sometimes they're investment opportunities or trade opportunities. Other times they're opportunities to get out of areas that could imply high amounts of risk or could signal turning points in the market or the economy. And if you want to learn more about what we're doing at MacroVisor, check us out at macrovisor.com. You can get 30% off. You just go to the website, and when it asks you to sign up, you'll have an opportunity to get 30% off till May 30th. So until Tuesday, May 30th, you'll have an opportunity to get 30% off for the first year, whether you choose a monthly or yearly subscription. So that's a really, really big discount. We're doing that just until the end of Memorial Day weekend on Tuesday. So we hope that you'll take advantage of that. We think it's a really good offering, and certainly we appreciate all the support we've seen so far. We have well over 7,000, almost 8,000 subscribers over at MacroVisor right now. And we hope you'll come over and join us for the content that we're sharing regularly that we think is very helpful to all of our subscribers, all the people that support us there. Small bank reserves are as low as they're going to go, drying up a source of funding for loans. This is a really big issue, because what you're seeing with this is that one of the places where banks are going to lend from is no longer available at the scale that they need, particularly with so much debt coming due, needing to be refinanced from commercial real estate in the area of office buildings. And office buildings have the lowest vacancy rates, the lowest occupancy rates that we've seen in history. The vacancy rates are very high. So what does that tell us? Well, we haven't even gone through the whole de-risking process where people start canceling leases and, shrinking their office space or just completely closing their offices. There's a combination of remote and hybrid work feeding into this, but also a slowing economy and more businesses moving out of metropolitan areas. So this is going to cause problems for the commercial real estate debt in the form of office building loans that are starting to come due in the second half of this year, because not only are banks owed the money, but there's also a fair number of banks that don't have the amount of liquidity they need to lend to these building owners should they choose to refinance. So we may see some turbulence related to this as we navigate the back half of this year. And when we look at this chart showing the fastest money supply contraction since the 1930s, what happens next? This is a chart from Deutsche Bank, and I think it's an interesting one. Now, I like to look at this chart in two different ways. This chart, or this, I should say this data in two different ways. This chart is of the US money supply year over year, right? So this chart shows us when the money supply is contracted. And it's contracted rather remarkably, but you can see that it grew significantly before this contraction. If we look at this on a trend chart, it's basically just following the uptrend, reverting lower to the core trend line. Now, I know you don't typically do technical analysis on money supply, but I think it's important to consider that when it's in that sort of a trend, it's reverting back to the trend growth. So it's just showing us that it's going back to the level or the rate of change that it was at before. If it starts to cut through there and we really start to see an even more meaningful decrease in money supply, then I will get more concerned. But I do think it is worth telling everyone out there that's not familiar with why this is important. If money supply contracts, there's less money available for people to pay the interest on their loans. There's less money for banks available to lend out. And we can see that in some of the previous charts. That does tighten credit conditions. It also makes it more likely there'll be delinquencies and defaults on loans. So all these things are worth considering from the kind of perspective of how does it affect the larger economy? It does so in a negative way. It takes some of the juice out from what is used to feed the economy. This is a debt-driven economy. If there's less credit available, there's less debt that can be issued, then there's less room for growth. Because a lot of the growth in the US economy is from credit allowing the borrower to pull forward demand from the future into the present. And if that is coming at a higher cost and less of it is available, then you can reasonably expect there'll be less, if not negative, economic growth. There will also be more challenges to paying back debt and to getting debt refinanced or issued. We can also see commercial real estate transaction volume has fallen sharply. And this is the lowest levels that we've seen really since COVID. Why does it matter? Because there's just a big slowdown in this space. And everything points to there being problems in commercial real estate, particularly office buildings, later this year. And so this is an area that I think is really important to keep track of because we're seeing more stress, we're seeing more vacancies, we're seeing more signs that really this is probably the bigger issue for the banks. It's the liquidity crisis and the bank runs that we saw so far this year, I would say are more of a preview, because we could have a larger solvency crisis in part because of this stress. We also see rentflation continues to rise in New York City areas, including New York City, northern New Jersey, and Long Island. And this is a pretty stark rise. And this is something we haven't really seen since the 1970s or 1980s. So I would be keeping a very close eye on this. We're seeing this pattern in other large cities as well. And it just suggests the cost of living pressures for a good chunk of Americans are not easing up the way that we would hope. And the artificial intelligence rally is considered a baby bubble for now by Bank of America, resembling that of the Japan bubble or the biotech bubble. I think that it has the potential to move a bit higher, but I don't think this bubble is going to look quite as big as some of the others that we see on this chart. That's just my 2 cents, given where valuations already are starting this bubble. This bubble is really an extension from the ARK or FANG bubble rather than a new bubble in and of itself. We can remember that AI was a hot buzzword in 2021 and 2020 as well. And the probability of a U.S. recession as calculated by the New York Fed's model is 68% by April 2024. That is saying that anytime between now and then, there's a 68% chance of recession that will be in one by that point. Not at, but by that point. That's an important clarification to make. And we can see this is the highest level that we've seen since the 1980s when we had that double dip recession, due in part to inflation and the measures used to fight it. So that's everything I have for you all today. I really hope that you have a great Memorial Day weekend ahead. We have 2 specials to make you aware of. So I want to first just say I really appreciate your support, helping me grow this YouTube, all of the feedback and positive comments and great questions I've received. Everyone out there is amazing. And so really do appreciate all of you. And if you do like the stuff that I'm publishing on here, your support of my work helps to make it all possible. So be sure to check out macrovisor.com, where we make macro actionable and easier to understand. You can get 30% off your first year of Macrovisor until Tuesday, May 30th for Memorial Day weekend. And that'll be your first year whether you choose a monthly or yearly plan. Also check out TraderAid if you want to learn more about technical short to intermediate term trading. You can get 25% off using the code MEMORIAL25. Follow me on Twitter at Mayhem for Markets. That's at Mayhem 4 Markets. And be sure to like, subscribe, and share this video with your friends and colleagues if you enjoyed it. Thanks for tuning in.